Okay, yeah. So I am Jeff Walton, Punter Jeff on X. Thank you. I have recently taken a job in the Bitcoin space. I had quit my job in reinsurance back in February and just wanted to get a lay of the land of everything that's going on. So I'm now the VP of Bitcoin Strategy at STRF Asset Management. We're going through the process of a reverse merger, and our plan is to run a Bitcoin Treasury company. So it's really exciting. I can't speak too much about it. Maybe we'll have some conversations after a beer later today. And as I mentioned, Mason also took a job in the space, and the team is growing up and growing into opportunities. There's significant opportunity in the space. I encourage anybody, if you're interested in working in Bitcoin, start talking about Bitcoin, because that's how this thing works. When I quit my job in reinsurance, I realized very quickly that I was working in Bitcoin. Like when I quit my job in reinsurance and I had no job, I realized that I was working for the network. I was working for the Bitcoin network, just talking on a microphone, talking about what I was seeing, talking about my thoughts, the landscape of the market, how the world's evolving. That was working in Bitcoin. I was working for the network. Now it's just amplified, and I have the opportunity to make a big difference. So really excited about that. So today we're going to talk about strategies, Bitcoin-backed credit a little bit. So we've got this image here, and this is on the left-hand side, 1 in 100 people understand Bitcoin. So you can see the orange Bitcoiner up on the upper left-hand side. Now you go to the middle, 1 in 100 Bitcoiners understand strategy. So what strategy is doing, MSTR, the stock, they're buying Bitcoin, putting it on the balance sheet, leveraging their balance sheet to buy more Bitcoin. Now you shift over to the very right, 1 in 100 people that understand strategy understand their perpetual preferred equities. And our goal is to maybe make that a few more people today. So that's what this is about. Okay, so this next slide, strategy enables a wide variety of securities based on Bitcoin. So this is just to give some perspective, a little bit of what I was talking about previously in the last conversation is, historically, if people wanted to buy Bitcoin, you'd have to go on an exchange, you'd have to, move money somewhere and then figure out how to store it, because if you don't want it in an exchange, you got a chance you're gonna lose it. And there's all these different risk vectors that are just completely novel that the traditional financial world is not used to. And with the evolution of a company adopting a Bitcoin treasury strategy and buying Bitcoin, you now had an alternative. In 2020, you could either go the exchange route or you could buy MicroStrategy. Now in 2024, you could either go to the exchange or buy your MicroStrategy. Now you could buy a Bitcoin-backed ETF that tracks it 1-to-1. And now in 2025, you have these new instruments. So what strategy is doing here is they're taking Bitcoin as a commodity and changing and morphing it and transforming the volatility into different products and different instruments. So I like how they have this laid out here. And you can see, so you start with Bitcoin over on the left-hand side, and these instruments that they've got outlined in the middle, you can see the different volatility metrics here in the middle. And if you go and you look at the very top here, you've got MSTR options. And this is the most volatile, right? If you want the most volatility in the Bitcoin market, you go and you look at the MSTR options, so that you could take extremely volatile exposure. If the price goes up in options, it may go up 10x. And if the price goes down in options, it may go down 10x. So you could get a lot of volatility exposure. Now, if you go down the list here, you look at MSTR. It's slightly down from MSTR options. You look at IBIT, it's right in the middle. IBIT is going to give you 1-to-1 Bitcoin exposure less the expense ratio. You know exactly what you're going to get. There's nothing that's going to deviate from your understanding of what that instrument is. Now the convertible bonds were some of the first forms of leverage that strategy created to leverage their balance sheet. They effectively borrowed capital from the fixed income market, the convertible bond market, with the notion that they were going to pay back the debt at a future point in time, plus a 40% premium paid out in equity. Now, the challenging part with the convertible bonds is they weren't available to the retail market. So the bond market was the only group of people that could buy these instruments. But there was significant opportunity, and their strategy noticed that there's this huge pool of capital that's really interested in MSTR, and let's offer some instruments to them to give them access to these types of securities. So when they developed the first perpetual preferred offering, you can see it sits right below STRK, it's less volatile. And so how does this work? How does STRK work? How do these less volatile instruments work? When strategy issues these instruments, they are reducing the upside that you can get from holding this instrument, but they're also reducing the downside of that instrument. And when they do that, that excess upside and that excess downside is delivered to the MSTR shareholder. So they're effectively monetizing their capital stack in order to provide different volatility exposures. So you can see these other instruments as you go down the list here. STRK is most volatile, STRF, STRD, STRC, low volatility. So let's go to the next slide. So this is what I meant by capital structure. So with the capital structure, if you are the furthest away from risk, you're at the very top of the capital structure. That means in the event of a bankruptcy or liquidation, if you're at the top of the capital structure, you get paid out first. This is just how it works in traditional finance. Let's just take a company like, I don't know, Walgreens, right? If you provided debt to Walgreens and they go bankrupt and they get liquidated, the people that hold the debt get paid out first. Anybody that holds the stock, they get paid out last. So you could say if you hold the equity, you are closest to risk. You're taking the most risky position within the capital structure of the capital stack. So you could see that laid out here. And the capital structure is designed, I mean, they picked a pyramid, which probably wasn't a great look, but the capital structure, if STRF sits at the top of the capital structure from the preferred equities. So that means they are the furthest away from risk. So if in the event there's any bankruptcy or liquidation, the MSTR stock, which is down at the bottom, would likely be worthless, and the other instruments would get whatever money is left over in the event of a bankruptcy or liquidation. So you are taking on risk when you're buying any of these securities, but the way that the capital structure is formed indicates to you what type of risk you're taking on, where you sit within the capital stack, and you can make your own assumptions about what that risk is and the volatility of that risk and what your return should be. How much return are you willing to accept for that risk that you're taking on? So they have designed this capital stack to fit different instruments in different places to provide different risk return metrics to different pools of capital, different people that are interested in different types of things. So there are different capital pools, and this is a perfect slide. There are different capital pools that are interested in different types of securities. So looking at MSTR, so on the y-axis you've got seniority, so low seniority in the bottom, high seniority on the top. And on the x-axis you've got volatility, high volatility on the right, low volatility on the left. So if you look at the most risky instrument, it's MSTR in the capital stack, which is the common equity, the most risky. It's the highest volatility and the lowest seniority. And you look at another instrument like STRF, which is the most senior, sits high up in the capital stack, and it's got moderate volatility, sits somewhere in the middle. And each one of those different instruments has different buyers. As I mentioned earlier, 1/3 of the capital in the world is fixed, they manage fixed income instruments. The people that manage fixed income instruments are never going to buy Bitcoin because it does not fit within the mandate of what they can buy. Even though everybody in this room would probably say they would be much better off if they just didn't buy the fixed income and bought Bitcoin and held on to it for 4 years. I agree. Everybody would be better off if they just bought Bitcoin, but they can't. So strategy saw this as an opportunity. Okay, there's a $300 trillion pool of capital that's interested in lower volatility exposure. So how can I create and design an instrument such that I can get access to that pool of capital and bring that money in the door? And that's what these instruments are. And each one of these instruments with different seniority and different volatility have different risk return profiles, and they access different pools of capital. So that's one of the biggest unlocks of this whole thing, is that they're identifying different areas to bring capital in the door. And one of the reasons this works is because strategy as as a seller of these instruments and securities in the market, they are incredibly transparent. So they know 100% of the time, anybody that buys these instruments, retail or institutional capital, they know 100% of the time how much risk is in this instrument at any point in time. So you could go on the strategy website, you could look at the amount of assets that they have on their balance sheet, you could look at how many liabilities they have on their balance sheet, you could look at the collateralization levels of these different instruments and see what's the probability that this company does go bankrupt or gets liquidated, and make your own assessments on that particular risk. So I think that collateralization concept is important. I think our next slide covers that. Okay, so you start to, I'm kind of getting towards this framework of risk here, and you start to think about what are the risks of these different instruments, and you compare the risk of these instruments relative to the other things in the market. You've got, let's just give, for example, Boeing Perpetual preferred stocks. What's the risk of Boeing preferred stocks? Well, you've got airplanes falling out of the sky, you've got lawsuits out the wazoo, and you've got a bunch of physical risk, and you're making an assumption that no competitor is going to come in the door and be able to, dethrone them as the primary airline company in the world. So you've got a unique risk profile over here. Now you look at the risk profile of these instruments, and you say, okay, well, what's the risk of bankruptcy or liquidation? It's the ability, will strategy be able to pay out their liabilities into the future? And what's the probability that they will be able to pay out their liabilities in the future? And what would need to happen from a volatility perspective in order for strategy to not have the financial strength to pay out those instruments into the future? So this slide is a really good example of the collateralization level relative to the yield in the market. So all of these dots over here on the left-hand side, these are the other preferred equity instruments in the market. And the colored instruments, these are strategies, perpetual preferred instruments in the market. And I think this is valuable to understand here because you see that the strategy instruments are in a league of their own, and they're significantly over-collateralized. What does that mean? That means they have significant number of assets relative to their liability on the balance sheet. And compared to everything else in the market, if they are, the other preferred equity instruments in the market are betting on and gambling on the future cash flow to be able to pay out that liability in the marketplace. So as I mentioned earlier, I think the entire landscape of risk is mispriced. I think the things that are over on the left-hand side are probably priced too low, and the things on the right-hand side are probably priced too high. None of this is financial advice. This is just my perspective on risk in the market. Let's go to the next slide. Okay, so this is also really fascinating, and watching the evolution of these things, because these are perpetual preferred equities. And so what this slide is showing is the perpetual preferred equities offer superior yield and liquidity. So over on the left-hand side, again, you've got yield on the y-axis, you've got 30-day average trading volume over on the x-axis, and you've got the different strategy instruments are colored here. And the reason this is important is if you're interested in fixed income or holding fixed income instruments, and you have a significant amount of principal in any of these instruments, you may want to be in a position to trade or move those instruments at any point at any given time. And with the strategy perpetual preferreds being highly liquid because they are a function of the underlying liquidity of MSTR, the underlying liquidity of Bitcoin, which are some of the most liquid instruments in the market, that superior liquidity should come at a premium. They should be priced at a lower yield relative to the other instruments in the market because they are more liquid. You have the ability to go get your principal back at a point in time if you need them. And that's just a new evolution of this marketplace. Most fixed income instruments are very illiquid. If you want to go trade Microsoft 10-year bonds, you got to go find a buyer. And if you need to do it in scale, it's incredibly difficult to do. And so this type of liquidity is a new evolution in the space where there's going to be significant trading pairs between all of these different instruments in different directions and new algorithms that come into play that are trading credit in a different way that's never been traded before. So there's just a lot going on in the space. Very difficult to explain to people on a short time horizon, so this is my goal here. So let's talk about risk. And I made this right before this presentation, so we're going to walk through it. Can you guys see the numbers? Yeah, is this good? Okay, so I want to talk about MSTR's ability to raise capital and just do like a little stress testing, just a basic mathematical representation of risk. So on the left-hand side, today, MicroStrategy holds 628,000 Bitcoin. The Bitcoin price is 115,000 plus or minus. So in fiat, they hold $72 billion worth of Bitcoin. That's a ton of Bitcoin. Billions of dollars are really hard for people to conceptualize. It's so much money. It's just an absolute ton of money. Now, the perpetual preferred principal that they have outstanding is about $6 billion. And let's assume the composite interest rate on that perpetual preferred instruments are 10%. The composite annual dividend that is required, that Strategy is required to pay, is about $600 million. So that annual dividend percentage as a relative to the capital that they have on their balance sheet is 0.83%, 83 basis points, less than 1%. So you look at those numbers and you say, yeah, they're going to be able to pay the dividend. I don't even care. They have so much money. They have so much capital. If they needed to sell Bitcoin, sure, go do it. But the reality is they're using the MSTR ATM and the liquidity in the MSTR ATM to pay dividends as needed. Additionally, they have business operations. So they have a significant ability to raise capital. What I'm trying to emphasize here is they have incredible financial strength. Let's look at the right-hand side. Let's stress test this a bit. What if Bitcoin drops 50%? And in years past, we've seen Bitcoin drop more than 50%, 60%, 70%, 80%. We could talk about this later. But let's just say, what if Bitcoin drops 50% from where we're at today? So the Bitcoin held is 628,000. Bitcoin price goes to 57,000. They would have $36 billion of capital, $6 billion perpetual preferred principal, and $600 million of composite annual dividend that they would have to pay. So you look at this dividend as a percentage of the capital that they have to pay, and it's 1.66%. So it's still an incredibly small portion of the total capital that they hold on the balance sheet. So even in example 2 on the right-hand side, incredibly strong. Like they're an incredibly strong financial company. So I want everybody in the room to put your underwriter hat on. I'm going to try to bring this to like normal levels and try to get people to wrap their head around it. So on your left-hand side, let's take the same exact relativities here. Let's just say you wanted to go get a loan to buy a house. And you have $7 million of assets, and you wanted to go get a $60,000 loan. So your loan to value would be 0.86%, the same as the left-hand side of the last slide. Would you underwrite this loan? Absolutely, right? You're like, oh my God, you want $60,000 relative to $7 million? Like, of course I'll give you this loan. Like, you're good for it. Like, the answer is you're good for it. Now, let's say your assets drop 50%. Let's take the same perspective. Your assets drop to $3.5 million, and you still want to get a $60,000 loan. 1.71% of the loan to value. Would you underwrite that loan? Yeah. Absolutely, right? So, like, that's the message that that's the message that's happening in the market, is that even if the price of Bitcoin falls drastically, you can still analyze the balance sheet and look at the financial strength and say, yeah, there's still significantly strong. They're still incredibly strong, and they have the ability to go raise capital, whatever form of capital that may be. It could be the MSTR ATM. It could be the ATM on any of the other perpetual preferred instruments. It could be convertible debt, it could be straight debt, or they could sell the Bitcoin, which would be probably the last priority. So the concept there being, they have so much money, and even if the price of Bitcoin falls 50%, 60%, 70%, they're still going to be able to go out to the financial world and the capital markets and tell a really good story and have the ability to go raise capital. And so managing the leverage ratio is incredibly important, and managing volatility and having a fundamental mathematical understanding of the volatility is incredibly important.
Yeah, let me jump in here.
Yeah.
So I think generally what I've seen in the Bitcoin space is there's a ton of skepticism about what are Bitcoin treasury companies and fundamentally what are they doing. And I like to step back and think, from first principles, if Bitcoin is going to take over the world, if it's going to suck in all of the capital, realistically, how is it going to do that? And how I think it's going to do that is through Bitcoin Treasury companies and through these different instruments, which they are uniquely able to access different capital pools via these instruments. So STRK, for example, it's like real estate. STRF, STRD, STRK, again, they're like bonds. They provide a coupon. STRC, which has been a smashing success, they raised $2.5 billion and now another 4.3, I believe. It's like a high-interest savings account. So that's going after the money side of things. But if you really, if you cut these up, these are broad generalizations, strategy is going to be able to access uniquely American capital pools first. And other Bitcoin Treasury companies globally are going to be able to reach other capital pools that strategy can't. For example, Metaplanet today announced that they had released preferreds in Japan. So they are going after capital pools of yen that strategy otherwise wouldn't be able to access. And that's why you're seeing all these companies pop up everywhere across the world, because they are going after capital pools that they can only uniquely access, if that makes sense. You have anything to add? Yeah.
Okay. Yeah, pull this up. This is the Pentagon of defense for Bitcoin. So similar to what I was mentioning earlier, there are going to be so many different ways that algorithms and traders and retail investors and other types of investors are going to play the Bitcoin ecosystem here in the future. And here's, 5, 6 examples of what people would do, right? All of these lines, I mean, yeah, it looks a little satanic, I guess, with some lines and a star, or whatever, whatever people want to think on that front. But what I'm trying to point out is there's a bunch of different arrows here, and at different points in different cycles or whatever is happening in the market, people might move in between any one of these individual instruments in different ways. So, for example, if you think if you're in MSTR, again, none of this is financial advice, but just some perspective on what I think may happen in the future. If you're holding MSTR and you see the price of MSTR run up significantly and you're like, wow, I'm sitting on some significant gains here, I might want to move my position from MSTR to something a little bit more stable if I think the market might be turning the other direction. So you could go from MSTR to STRC or STRC to STRF, depending on where you thought the risk was in the market and how much risk you wanted to take on within your portfolio. And none of these are mutually exclusive, right? You don't have to just hold one. And I think that's the really neat part about the evolution of the space, is that this is a risk curve. Every single one of these different instruments has different risk profiles. So you can have various percentages of all of these things. And let alone, like, this is just one company. There's going to be a dozen companies that are coming out with the same very similar type instruments with different risk return profiles and different exposure to different jurisdictions in Brazil and Japan and all these things. So this space is evolving very fast. And what I was mentioning earlier, the plumbing is fundamentally changed. You can now move into different instruments with low vol exposure and still stay within the Bitcoin ecosystem. And I think the harsh reality of these new instruments is that the return and the risk return profile are too good to ignore. And the success of these just over the last 6 months, which I suspect will play out into the future as well, the success is so good that fixed income managers have to add these to their portfolios. And once they are in portfolios and fixed income managers start outperforming other fixed income managers, money and capital is going to move to success. And that capital coming in the door, it just brings more capital coming into Bitcoin, because what is Saylor going to do? He's going to take that money in the door and he's going to go buy Bitcoin with it and just keep the cycle going. And the last thing I'll hit on is the credit rating agencies. So this is a big topic in this space at the moment. every single one of these preferred instruments are unrated. That means that means Strategy effectively hasn't paid an institution to rate these products appropriately, and the rating agencies, not only is the rating agencies also do not understand the risk profile. They're likely misunderstanding the actual risk of these individual instruments. So because of that, because these products are unrated, that actually limits the amount of capital that can buy them. Just like I said earlier, fixed income managers can't go buy Bitcoin because it's not within the mandate. Well, fixed income managers also can't, most of them can't buy unrated instruments. So once these products become rated, that's a significant unlock for a much larger pool of capital that has the ability to buy these instruments moving forward into the future.
Yeah, I just want to add that these products, the reason that they exist is because people have unique different needs, and pools of capital have different exposure needs, whether it's fixed income or equities, et cetera. And none of this detracts from holding Bitcoin in self-custody. So far, Bitcoin Treasury companies have scooped up 4% of the network, and mainly that's Strategy. And I think it's important to recognize that the 4% that they scooped up benefits the 96% of the network that is not a Bitcoin Treasury company.
Yeah, the people that run these Bitcoin Treasury companies really get a lot of flack sometimes. Like Saylor and team, even myself, like I get deemed a paper Bitcoiner. It's like, well, I hold Bitcoin, I have Bitcoin in self-custody. I am a Bitcoiner. I operate my life on a Bitcoin standard. The reality is everybody that's running these companies, they're on Team Bitcoin. We're against the traditional financial world. Like we are going up against a $300 trillion class of capital that we're trying to convince that these are superior instruments because they are. And we're all working in the same direction. I would rather have Bitcoiners be in this position than the likes of JP Morgan or Morgan Stanley or anything like that. So I'm incredibly excited and bullish about this space and where it can go.
Should we take some Q&A?
Q&A? Yeah, let's do it.
Yeah, Q&A, anybody? That was awesome. That was awesome.
Come over here.
Tim?
So guys,
Yeah,
great. Based on the call yesterday, the ATM on MSTR is off for right now.
Yeah.
Stretch is the new iPhone.
Yes.
So that's where they're going to get all their money. Their slides say that there's an ATM, but I thought the ATM was not in existence for Stretch yet.
It was filed yesterday.
Okay.
Yeah, it was filed.
That's where I missed it.
Yeah, so I think it's a $4.2 billion ATM. It was filed with the SEC yesterday.
So to raise capital in the near term, are they going to be hitting Stretch before it gets to their target of 99 to 101?
I doubt it. Yeah, I highly doubt that because, again, going back to this transparency component, they've come out and have been incredibly transparent about how they're going to operate with these instruments. So if that capital comes in the door, I think they really want to peg a Stretch to $100. And once it does get up to $100, if there's additional interest in that instrument, then they would use the ATM. Like if it starts trading above 100, they would use the ATM to bring it back down.
So the near term is the other three.
Near term is probably the other three, yeah, Strike, Strife, and Stride. And there's significant volume in all three of those instruments. I still think the market doesn't understand these. The capital that came in the door to buy these IPOs, I think is largely turned over at this point. So there was significant IPOs in all three of those. And I think a lot of the capital is not necessarily holding long term, but they've just since turned over because they've had significant returns.
Yeah, I think Stretch is profound because it's the single best thing that you could do with short-term capital right now, right? So I imagine a scenario where people are selling the Bitcoin top, trying to time it, and then they're like, all right, I have all this cash. What should I do with it? And right now, the single best thing you could do with it is put it into Stretch and get 9%. But what does that lead to? Leads to Strategy buying more Bitcoin. So it's an incredibly reflexive, virtuous cycle.
It's the I'm probably going to regret saying this, but it's like, it's the kick yourself in the dick trade. It's like, well, I'm going to sell the thing to buy the thing that actually makes Bitcoin go higher, which makes the thing that I just sold more valuable than the thing I just bought. Anyway, yeah, go ahead.
You could call it the Ouroboros trade, the snake eating its tail.
Yeah,
It's probably
exactly.
PG-13 version.
There you go.
Hey, my name's Kevin. I just first off wanted to say thanks to both of you guys, but by extension, the whole True North crew. I mean, Wednesday nights are best night of the week. Go to band practice and then eat dinner with my wife and then watch you guys. So I really appreciate that.
Thank you. Yeah.
Yeah, my question is about the transparency that strategy has shown from the beginning. Similarly, on a Saturday, I can go to strategy.com and just see how my investments are doing. You guys both work for Bitcoin Treasury companies. Maybe you could just speak a little bit to that example that they've set all the way back, because I do think that's a choice. They didn't necessarily have to do that. So any thoughts there?
Yeah, the transparency is incredibly important if you want access to capital. And I think that's where this becomes, pretty profound if you're managing a capital in a Bitcoin Treasury company. The reason being, if you want to go raise capital, your counterparties, there's still a lot of trust in the traditional financial system. So you want to be able to trust that the person that you just gave money to is going to do exactly what you said you were going to do. And that's setting this really great example for any other companies that are coming to the scene here. It's like, and Saylor's even said, copy what I'm doing. Go look at my website. It's like, go copy it. Please just put it up there and have this transparency in the market. Because the reality is, if you have opaque risk on your balance sheet, your ability to raise capital is really difficult. You got to go convince somebody like, oh, hey, yeah, go look at this strange risk over here and quantify it. And I think there's a 1% probability that it's an issue. And then the person that's trying to give you money thinks it's a 10% probability it's going to be an issue. And they're just not going to give you capital if they don't trust that transparency. So it's incredibly important, at least with where we're at right now. This ecosystem is so young that having transparency and operating very professionally and strict in the market is just incredibly important. And I think will continue to be incredibly important until, maybe 15 years from now when Bitcoin's a $21 trillion, $40 trillion asset and there's more niche fringe things going on in the market.
Yeah, how many companies in the world allow retail investors or retail analysts to come up on their earnings call and ask a question, right? That's pretty unique, and Jeff was able to do that yesterday. But also, I think Saylor is the most transparent leader in the world. He's done over 200 2-hour podcasts for the last 4 or 5 years, and yeah, I think they just have a general ethos of transparency because they know that this is such a radical and new idea. The only way that it's going to be accepted is by being fully transparent.
Yeah, and one other thing I'd add there is, like, you think about the scale. The scale is incredibly important. Go back a slide. Right. $300 trillion bond market, $330 trillion real estate market, $120 trillion money market. If strategy, if they think they can get to 1% of the bond market, that's $3 trillion. There's not a single company on the planet that has $3 trillion of capital. There's a $3 trillion company, but maybe they have $100 billion of capital. So if you're going to get to 3 trillion, you need to be transparent. You're not going to get to 3 trillion unless you're incredibly transparent.
Also, something I didn't mention about this, but you see in this pump, as they pump capital from real estate, bonds, money, etc., it's highly reflexive because once they get placed into these market cap weighted indexes in equity markets like the S&P 500, like QQQ, etc., once they have more capital, they become larger and they go higher up in the index and hence get more capital, more flow, which allows them to
increase the assets out of the balance sheet, which makes the risk less.
Yes, and that's indiscriminate capital flow. It's from everyone everyone's grandma, grandpa buying the S&P 500, and they get access to Bitcoin, whether they like it or not. I think that's eventually where I see this going.
Yeah, go ahead next.
Yeah, considering you guys have both taken on new roles, I'm curious if you can provide any interesting facts or color on how you got your jobs. I know, Jeff, you were saying before, just be active. Mason, I'd be curious, if you speak Portuguese or have a, Brazil relationship, anything like that.
No. In March of 2024, Jeff released Quantbros 1, and I started irresponsibly long MSTR, like the Twitter community, and I reached out to Jeff and I interviewed Ryan and him, and from that moment on, Jeff and I have been in correspondence, and he invited me on to MSTR True North, and I would say more than anything, what's really helped me is being passionate about it and loving it. Jeff and I were just talking about it. This feels like play. We're so excited to talk about it. Like, this excites me. Like, this is beautiful to me because it's money, capital is going into Bitcoin, which otherwise would have a hard time accessing it, and it's creating the world that I want to see, which is hyper-Bitcoinized.
Yeah, I'd also add the world's changing. The way people hire people, like the world is just completely changing. And what I've emphasized to most people that I talk to about this is like your X profile is a resume. Like the traditional resume is gone, right? Because my wife's a recruiter, I know about this. So there's AI is looking through all of these different resumes and picking the top 10, then you got 10, you got to go interview one, and then, it's not very authentic. And in this space, like, authenticity is certainly rewarded, and following your passion and what you're interested in is rewarded. So coming to these events is also incredibly important. Getting out in the market, talking to people, and building your new digital resume in this new digital world, I think, is really kind of what put me on this path to where I am. And when I started talking about this stuff, it was super risky. Like, people think that I just, landed into this stuff, but I put my job at risk. I worked at a reinsurance company that didn't understand what was going on in this space, and I was talking about this stuff every day. I brought it up when I was going to capital providers in London and Bermuda and New York, and I was just trying to think of the world in a different way, and I took on a lot of risk doing those things. So it's just kind of within everybody's risk tolerance for your ability to do those things, but that's kind of what
Yeah, and one final thing, the power of the internet is extraordinary. I think Jeff and I have both experienced that. If you put yourself out there, you never know who will see it. There's been some incredible people who've reached out.
Oh, yeah.
All right, we've got time for one last question, and then it's lunch. Oh, are you over there too?
Yeah.
All right, well, let's see how fast this one goes.
Yeah, cool. Hey, my name's Bob. When you talk about risk, Jeff, when we talk about the risk of bankruptcy or liquidation, but then you hear how frustrated you get because it's like a meteor strike or, some low level. Yeah, it's this zero risk, but in some ways, strategy had to bend the knee on the converts to get into the game, and then bend the knee on this to get into the game, right? And it's like, we know the risk is zero, but you can't just go and present it as the risk is zero, right? You have to play their game.
Yep.
Where do you see this 4 years from now, when people start to realize that risk is zero? Are you going to have these instruments priced at $200 each, and the interest rates come back to meet the market? And then what would other new instruments look like that are in a world where people understand the risk is zero?
Yeah, I truly believe that there's going to be a landslide of capital that comes into these instruments once the relative risk framework is largely understood by the market. That's a great question. And what I mentioned earlier, I think the entire world of risk is completely mispriced. That's just the way I see things from a Bitcoin lens. And what the catalyst for that, I think, is this the credit rating agencies sticking their neck out and rating these instruments appropriately or understanding the risk framework. What does that take? When does that happen? No idea. It could happen in a year, it could happen in 6 months, it could happen in 4 years, it could happen in 10 years. But as more companies come to the scene and offer different alternative instruments, there's going to be other securities that MSTR will be measured against, and there will have some peg to what the relative risk may be. So, yeah, it's evolving. Sneak in there.
First, thank you so much. Not sure if this is really a question, but just to say, you've given such a gift to us as a community. You've devoted so much time and energy personally, and it's made such a big difference to, I know me personally and so many others in this room. It's a very kind of lonely journey, the Bitcoin journey, and the MSTR journey. It's such a sophisticated trade, as you're always helping us understand, and it just means so much. So you guys, Mason, you're so young, so smart. It's incredible. You guys are going to continue to take over the world. Just want to say thank you for everything you've given us, and I hope to be on the journey with you, as it continues. Thanks so much.
Yeah, thank you.
Appreciate it.